Want to secure your financial future with stable returns? Here's what you need to know before diving into the U.S. bond market. Hey everyone, welcome back to The Bond Guy. Today we're breaking down everything you need to know before investing in the U.S. bond market. We'll cover the basics, key features, risks, and even some insider tips from a 30-year veteran. That's me. First things first, what is the bond market? In simple terms, it's a marketplace where investors buy and sell fixed income securities, typically bonds. Those bonds are issued by governments, corporations, and municipalities. But first, let's take a step back. Think back to when you bought a car, or perhaps you bought a home. You were the borrower. You were borrowing money to make that purchase. Well, if you become a bond investor, the roles are reversed. The corporation or government is actually borrowing money from you. So let's talk about different types of bonds. We'll talk about U.S. Treasury bonds, corporate bonds, and municipal bonds. First up, our safest option, U.S. Treasury bonds. Government or Treasury bonds are the safest investment you can make. They are backed by the full faith and credit of the United States government. They come in different forms: Treasury bonds, notes, and bills. And really those are broken up into different maturities. But let's take another step back. What does that mean, maturity? So when you bought that car, the term of your loan may have been 5, 6, 7 years. Well, bonds work the same way. You loan that money to that government or that corporation for a certain amount of time. That's the maturity date. You'll hear that term a lot. Let's move on to corporate bonds. Corporate bonds are issued by companies looking to raise capital. These can offer higher returns than Treasury bonds, but come with additional risks. We see some of the biggest names borrowing money in the corporate debt markets. Names you're really quite familiar with. Companies like Apple, J.P. Morgan, Berkshire Hathaway of Warren Buffett fame, just to name a few. Now let's move on to municipal bonds. Municipal bonds are issued by states, cities, towns, fire districts, school districts, turnpike authorities, and sometimes even municipal utilities. Provide water, sewer, gas, electric. The key takeaway on municipal bonds is their tax exemption. While the interest rate you receive may be lower than some other bonds you may buy, like corporates or treasuries, often enough, the interest you earn is exempt from federal taxes, and in some cases, your state and local taxes as well. Have you ever gotten to the end of a great investing year only to get slammed when your tax bill came? Imagine earning thousands and thousands of dollars from your municipal bonds, and at the end of the year when you do your taxes, not having to pay any taxes whatsoever on those thousands and thousands of dollars. It's kind of a nice feeling. That is what municipal bonds can do for you. So let's talk about some key features of bonds. First up, interest rates and yields. When you buy a bond, you're essentially lending money and receiving an interest payment in return. Understanding how interest rates and yields work is crucial. One fundamental principle of bonds is that when yields go up, prices go down, and the same goes in reverse. Always remember that, because it's always the case. Another key feature of a bond is its maturity date. This is when your principal will be repaid. Bonds typically come with maturity dates that can be as short as a month and as long as 30 years or even longer. I've seen bonds that were issued with 100-year maturities. The last key feature we'll touch on is credit ratings. Credit ratings are provided by agencies like Moody's and Standard & Poor's. They help us assess the risk of the bond. Higher ratings typically mean lower risk, but often mean lower returns. These are just a few of the key features of bonds. We'll do a broader examination of bond features in future videos. Next, let's move on to some of the different risks associated with bonds. First up is interest rate risk. As I mentioned before, when yields go up, bond prices go down. The thing to remember here, though, is that while the price of your bond may go up and may go down, if your intention is to hold it to maturity, you've completely insulated yourself from any volatility in the bond market. You know that you're going to receive your interest payment on a regular basis, and in the end, on maturity date, you'll receive your principal back. So what the market does in between the day you purchase it and on the day in which it's redeemed simply doesn't matter. Next up is credit and default risk. Default is when a bond issuer is financially unable to make interest and or principal payments. Often when you see your rating on your bond go down, you may see the value go down as well. And the same works in reverse. If you see that rating go up, you'll see that market price go up. Another type of risk is inflation risk. Let's use an example to help visualize that. Let's say you buy a bond with a 5-year maturity, and it pays you 5% every year. If the inflation rate is, for example, 9%, your actual rate of return is -4%, simply because your interest payment is not keeping up with the rate of inflation. Now let's talk about some of the benefits of investing in bonds. First off, stability and predictability. Typically, bonds are less volatile than stocks and can provide a steady stream of income. Let's try another example here. Let's say 5 years ago, you had bought an AT&T bond. And for simplicity's sake, let's say you invested $1,000 and the interest rate was 5%. You would know that every year you would receive $50 in interest payments for those 5 years. And just a side note, typically bonds pay interest semi-annually. So in our 5% example, you would receive $25 every 6 months. And so over the course of your owning that 5-year bond, each year you would receive $50, totaling $250 at maturity. Also in 5 years, you would receive your $1,000 principal back. However, if you had bought AT&T stock 5 years ago, that stock would have cost you around $26 a share. And while it paid a nice dividend, 5 years later, today that stock is down almost 9 points. So you can see the simplicity and the certainty that bonds can provide in your portfolio. Sure, that AT&T stock could have also gone up 9 points, and you would have realized a significant gain, but you wouldn't have had the certainty provided by the bond investment. Now let's talk about diversification. Investing in bonds can help diversify your portfolio and reduce overall risk. And last, we'll talk about tax advantages. Certain bonds, like municipal bonds, can offer you tax-free interest. Even treasuries, for example. Also, an often overlooked feature of treasury bonds is that the interest on those bonds is exempt from state income taxes. So how do you get started in bond investing? First, you should determine your overall investment goals and risk tolerances. Do you want to take a lot of risk, or is safety of that principal more important to you? This is the point where a lot of commentators will encourage you to buy a bond fund or buy a bond ETF. You won't find that on my channel. I've never been a big fan of bond mutual funds or bond ETFs. I believe you can better achieve your investment objectives by picking individual bonds to do exactly what you want them to do, to make the payments you want and to return your principal when you need it. And interest rates go up, the value of that mutual fund will undoubtedly decline. So if you have a 5-year time horizon, when you know you're going to need that principal back, you should be buying the certainty of a 5-year bond and not the uncertainty of an undetermined maturity date bond mutual fund or ETF. Let's say you're simply looking to place an investment that is going to track with interest rates as they go down, ultimately giving you an increase in your principal because of that change in the market. There are individual bonds that can absolutely capture that market move. To wrap things up, investing in the bond market can be a great way to secure steady returns and diversify your investing. Remember to consider the types of bonds, understand associated risks, and align your investments with your financial goals. Ready to start investing in bonds and secure your financial future? Subscribe to our channel for tips and future insights, and hit the bell icon so you'll never miss an update. If you found this information helpful, please give this video a like. It helps a ton. And always remember, the information provided by this channel is for educational and informational purposes only. Please consult your advisor to ensure the many facets of your personal situation are considered when investing. Please see the full disclaimer in the description below.